Welcome to Good Game, a podcast for crypto insiders with your hosts Imran and Qiao. Welcome to episode 7 of Good Game. A lot has happened over the past week to 2 weeks. And so what we're going to do today is we're going to take a different approach, which is answer questions from our audience, but more or less talk about how we feel about the space, where we think the space is going to go forward, and what the contagion may mean for the industry at large. And maybe Qiao, let's just get your quick thoughts on your thought, over what happened over the past week, and then we'll talk a bit about the FTX blow up.
Yep. Well, it's fair to say that this last week was the single most absurd week in the entire history of crypto that I've been here for almost 10 years.
Yep.
I think even Mt. Gox was unrivaled by what happened with the FTX. So I think there's a lot that we don't know for sure yet, but we can speculate on a few things. Imran, I don't know if you want to talk about some of the facts first with what happened with FTX.
Well, I mean, let's just talk. Let's talk about what happened, right? And what was interesting was I just want to point out a few pointers. First, what was very interesting was when FTX Alameda, when they were unwinding, the first entity or protocol they paid back was Aave and Compound, and so which was very interesting, right? I mean, like we always talk about decentralized finance and like how important it is to the industry, but in midst of a collapse, we're seeing Aave and Compound being paid back fully. And so if you look at the priorities, it shows you that decentralized protocols have the most priority. And so I thought that was very interesting. Yesterday, JP Morgan tweeted out, there's just too much power concentrated with centralized exchanges, and there is a clear opening for decentralized protocols. So JP Morgan published this research, and it talked a bit about the need for decentralized finance. And so I thought those were two interesting points that I wanted to point out before we just talk about the contagion generally. Some of the facts, Jason from BlockCrunch had posted a very in-depth tweet thread in regards to the entire FTX from the start formation all the way to the collapse. But I'll point out a few interesting tidbits. Alameda was first started. It wasn't FTX. It was Alameda. And the way they went out and approached investors was that they wanted to raise capital. And the promise was, low risk, high returns, right? You're going to get guaranteed returns of 15%. And, whenever you see something like that, typically, not all the time, but 90+% of the time, it's a red flag. There's an edge case, and the edge cases are primarily if they're incredible traders in the space, etc.
I mean, the better of a trader you are, the less you should be, posting that kind of stuff, like high return, no risk. By the way, right. I got caught in the crossfire, but we can talk about that stuff later. But I was among the people who saw the Alameda's pitch deck back in the day. And, a lot of people were skeptical about the returns that Alameda was generating at that point in time. They saw the P&L graph that Alameda showing in the pitch deck. By the way, I don't have the source anymore. It's been 3 years. But the P&L charts that the Alameda showed was a straight line up. And people were really offended by that. And justifiably so, because, in the vast majority of asset management businesses, you don't see that kind of returns. However, I actually come from a HFT background. I knew that kind of stuff was believable. But at the same time, the words that put in the pitch deck, high return, no risk, that was a huge red flag.
Yeah.
And I pointed out. But anyway, that was 2019. That was before FTX even started, I believe. So let's move forward in time.
Yeah. So 2019, Sam launched FTX, and the premise was, there's an opportunity for another exchange, and being that Alameda already has some share, they can use Alameda as a way to provide more liquidity to FTX. They can bring on more over time, bring on more market makers, and then token listings. So that was kind of the edge. And they later raised seed capital. They raised $8 million. I think some of the folks that stood out were like raised capital in Kinetic. But soon after, that's when the beef started between Alameda and Binance. I believe when Binance launched their futures exchange around that time, Alameda ended up nuking one of the markets. And so I don't. There's a tweet that's out there that shows CZ talking about this event and how they talked about a smaller market maker that was trying to nuke the market, but then they had a index price oracle versus just like a futures price oracle or something like that, which ultimately ended up saving Binance. But that was where the epitome of the beef started with Sam and CZ. And then there was pretty much hyperbolic growth right from there, because if you look at the exchanges at the time, primarily they were mostly Asian exchanges, and then you had FTX that was more of a trading focused exchange that really understood the problems that traders were looking for. So they launched some great products. And during the DeFi summer, they had hyperbolic growth. They launched Serum, and Serum was the ability for them they launched both FTT, which was the token that represents FTX. Mm-hmm. And then later on, they launched Serum, which is essentially a cloud-based decentralized exchange. And that was primarily predicated on Solana. Fun fact, at its peak, Serum was at $122 billion fully diluted valuation. Fun facts. So let's talk a little bit about Serum, right? I mean, do you want to touch on anything with the FTX story? Otherwise, I'm going to talk a bit about...
I think the single biggest elephant in the room that we as an industry somehow ignored was the fact that you have this giant exchange and you have this giant market maker, a really dominant market maker.
Yeah. And
they had the same route. They were probably run by the same group of people in the same penthouse. In TradFi, this would not...
It would not fly.
They would not fly. There's a reason why there's regulations around Chinese walls between the market making branch and the banking business at those investment banks. By the way, this regulation actually, I think it was rolled out during the GFC in 2008, right? They put a Chinese wall between the market making and the banking side of things. But somehow we as an industry just normalized this, and but in hindsight, that was one of the biggest red flags for me.
And many people memed about it, where Sam, they would have Caroline or Trabaco and Sam, and they would always say how Alameda and or FTX would be trading against their users. Yeah. So the meme was there, the story was there. Yeah. It just wasn't validated. Yeah. And over time, people have validated. Folks like Hasaka on Twitter and many others validated this through just the way the product has been ran. Yeah. So let's talk about Serum next, because all of this is going to play an important story to the collapse of FTX. Serum, they had about so Serum launched pretty early, and the idea behind Serum was let's launch a decentralized exchange that is going to be primarily predicated on Solana. It'll be cloud-based versus DEX, so price discovery, et cetera, will be much more better. Mm-hmm. And so they launched. I think at launch there was the valuation was at $1.2 billion at the day of the launch, which I thought was pretty extraordinary. Over time, the main function for the Serum token was that those that hold it would see the appreciation value, because the protocol itself would collect trading fees and use part of the trading fees to buy and burn SRM. The other, and this is probably another big red flag that the industry may have not seen it until like later on, was the fact that they only sold 3% of their entire token, their entire supply of tokens, 3%. So 97% of tokens were held by FTX.
And it was vesting for like 7 years or something. That was the thing that really stood out for me. Like I've never seen a token project that would vest over 7 years. Maybe it was 10. I can't remember. It was a really large number.
To me, like 7 years, at least at the time, signified that, okay, he's long-term committed, right?
Yep.
Yep. But now in hindsight, it's because he didn't want enough circulating supply.
That's right.
And so these are like all the kind of the yellow flags that we're starting to see. And even if you look at like its balance sheet, there's about $2.2 billion worth of tokens that are sitting on FTX's balance sheet of Serum. And so that kind of brings us to the point of like FTX's like assets and liabilities. Mm-hmm. Like what is the assets and liabilities? Like how bad is it really, and how is it going to affect people generally? Typically, how it works is that if you're an exchange and if you have customer deposits, you typically hold those customer deposits in cash or something, or like treasuries or something that's deemed to be safe. If you hold it against Bitcoin, it's still very risky, but fine. What FTX did instead was if you look at its balance sheet, about $14 billion of its balance sheet was in its own tokens.
Yep.
So a total of $19 billion there's a total of $19 billion in FTX's like exchange, right? From all the customer deposits. Of that, $14 billion is in its own shitcoin. You have, let's say, $4 billion in illiquid investments and $1 billion in like cash and mm-hmm. crypto and the Robinhood stock. And the other thing you want to keep in mind is that FTX, all of this is just predicated on launching more tokens where it retains a lot of its own token and then market these tokens to investors as a way to, generate FOMO and then increase the value of its token so that they can start to collateralize and borrow against it so they can do X, Y, and Z.
Yep.
And so with the crash with the Three Arrows crash, it turns out Alameda was in a very deep hole. And that deep hole, like they should have just like closed the doors and walked away. But instead, what Sam did was they lend out. I don't know the exact number; it hasn't been validated yet. But let's say $10 billion.
Yeah, basically, was in May or June? I can't remember when Terra collapsed.
Yeah,
that ultimately affected Alameda. Sam had two choices. At least that's my speculation. Sam had two choices. One is let Alameda go bankrupt.
Yep.
And two is save Alameda by giving Alameda FTX's customer deposits. And Sam chose the latter. That was the beginning of the downfall.
And so that's what they ended up doing. So somehow Alameda magically had enough FTT tokens. So they collateralized it with FTX, and FTX gave them the customer deposits. And obviously, we know what happened after that. Alameda went down or lost them customer deposits. And in fact, what they did was they started using customer deposits to invest in startups, yep. which I think was a horrible mistake. And many of these startups, when I've looked at the types of startups they were funding, they were very shady, like red flag, yellow flag type.
So Jacob actually wrote a good tweet on this. Like,
yeah.
How is that $10 billion worth of balance sheet hole broken down?
Yeah.
How is that broken down? Well, there's 1.15 billion on Genesis, $1 to $2 billion on Binance's stake in FTX, 1 to 3 billion on other VC. I think he means like all the venture investments that Alameda or FTX invested in. $1 billion on advertising. I assume that means like all the stuff with like
Tom Brady.
Yeah, Tom Brady, all those things. 10 figures or 9 figures worth of real estate, 9 figures worth of donations, including the donations to the Democrats, FTX Foundation, all that stuff, and then unknown amount on lending. The unknown amount on lending is also interesting because this whole contagion is related. Everything that happened since Terra to Alameda and FTX, this whole chain of contagion is one chain. They're all interrelated. At least that's my speculation. Again, like we don't know this for a fact yet, but we can only talk about things probabilistically. But this is my understanding. So when Terra collapsed, 3 Arrows happened to be recklessly leveraged, and they lost a lot of money. And the money that they lost were actually the money that they borrowed from centralized lenders, including like Genesis and probably a bunch of other big lenders. And then those lenders in turn borrow money from even others, right? Including Alameda themselves. And so when some of these CeFi lenders went bankrupt, or they went into a situation of insolvency, Alameda got affected by the same chain of contagion. So now Alameda has a hole, and then Alameda ultimately borrowed money from FTX, and the FTX money, whose money is that? It's the customer's money. So basically, this whole thing was basically converting the collapse of Terra into a hole on 3 Arrows, which ultimately converted into a hole on the centralized lending platforms, which ultimately converted into a balance sheet hole on the balance sheet of Alameda, and ultimately FTX, and ultimately the customers of FTX. So this whole chain reaction happened over the last half a year. And how did it take so long to play out? Well, it's just because FTX is such a big player. Like the smaller players were surfaced and basically discovered dead immediately. But the big players took a while. And this is exactly what happened in 2008. By the way, there's a huge difference between Alameda, FTX in 2008 in terms of fraud. But the chain of reaction, the contagion happened in 2008 over many months, from Bear Stearns to Lehman. It took many months for all the players to surface. But anyway, so that's my probabilistic understanding of what happened over the last few months.
Yeah, and then in parallel to that, we saw when that collapse happened, it turns out like Voyager was one of the largest holders of FTT tokens.
Yeah.
And so there was a fuel of making sure that FTT tokens didn't land into the public markets, or at least that is the narrative that's playing on Twitter today. Is that one of the reasons why that acquisition happened was so that they could get customer deposits and the tokens as a way to kind of like fulfill that hole, that ever growing hole that is going to continue to grow. And so you started to see this like acquisition strategy, which in part was primarily fueled by the hole in his balance sheet as a way to cover it up and then start to grow. And so he acquired Voyager, BlockFi as a way. And then in fact, within like there was a tweet thread, or there was a thread that talked about BlockFi's like assets. As soon as the acquisition happened, they forced the entire AUM of BlockFi and they forced it onto FTX.
Yep.
So that is like another signal to tell us that, this acquisition was primarily driven by the hole in the balance sheet, and they were trying to cover it up by more acquisitions.
Yeah, using the customer funds of other CeFi companies that they acquired.
Yeah. At that point, you're too big. It's too late, right? Like you're gonna fail. Like,
oh. And relatedly, I think people tweeted about this on Twitter, so it's not private anymore. But there's startups that raised money from FTX that were forced to store their treasury on FTX.
Yeah.
And that was yet another way to plug the hole.
So there was an article that talked about how much do you think crypto funds custodied their assets on FTX? Well, it turns out between $1 to $5 billion was custodied on FTX. That is now lost. I think the right answer is somewhere always in the middle, because truth is usually somewhere in the middle. So let's say $2.5 billion was lost, which is about 5 to 7% of all of the crypto funds AUM in the entirety of the crypto market.
How much?
7% of the entire market of the crypto funds AUM. So
7%. Okay, frankly,
these are ball. Yeah, it's not much, but for large funds could probably withstand it, right? The smaller funds are like Ikigai and a couple other funds that went on public on Twitter talked about how they're gonna need a bailout, or they'll need some way to get out of that hole. So I don't know what that means for crypto funds that are smaller size, which are liquid assets.
The funds that probably got hit the hardest are those who did short-term trading, because they had to have funds on exchanges in order to do short-term trading. Whereas the long-term funds, they can just custody their assets within a separate non-exchange custodian. And so if you look at the funds that do short-term trading, then chances are among those people, I think maybe on average, a third of their AUM is on FTX, because the alternatives are like Binance, Coinbase. That's pretty much it, right?
Yep. I mean, it's Binance, Coinbase, and FTX. For the average fund that I talk to in the US or Europe, etc., it's usually those three. And in fact, traders that are like high-speed frequency traders or like professional traders, they primarily use FTX.
That's right. Yeah, the market makers are definitely affected. They're the ones who have to be on FTX in order to provide liquidity on FTX.
Yeah, a couple more thoughts around there. We did a deep dive on Sam. Was it last session? Yeah, I think it was
two sessions ago.
2 sessions ago.
A month ago. And we talked about how Sam dominated institutions compared to Coinbase. Mm-hmm. And it turns out, about 70% of all trading activity that comes on FTX is institutions, whereas there's only a third of the total trading volume on Coinbase that are institutions. So it gives you the kind of the difference of the customers that they attract. So this hurt institutions a lot more than it did retail from at least the trader side. Obviously, there's a lot of retail that custody their assets too. Not saying that. Yeah. But the industry at large got hit. Anecdotally, I've heard that a lot of Asian, all the Asian retail traders that I've spoke with, pull their assets out on time. They were on extremely high alert relative to like Western, retail traders. And I just found it really, really interesting because Asian retail traders get fucked all the time by centralized custodians, so they were always on high alert.
How many? Sorry, go ahead.
No, but but at the same time, I also know a bunch of people who are based in like Hong Kong who got really screwed by FTX. But anyway, just an anecdotal observation.
Why don't we pause here? There's a bunch of questions that we got asked. And let's answer some of them. All right. So this is, do you think regulators even understand the difference between DeFi and CeFi?
Well, my answer to this a year ago would have been no, but my answer now is yes. They do understand. They actually, I think, the average regulator understands this stuff better than the average person on CT. But I think some of the aggressive stance is actually does actually not come from the lack of understanding, but actual conflict of interest between, how DeFi might potentially disrupt traditional finance.
And there's the crux of the conversation, at least for regulators, is who is liable, right? Or if we are a regulator, who do we regulate? Do we regulate the protocol? Do we regulate the people? Do we regulate, the community? And there is a question of trying to understand who are the regulators going to go after. And the argument that is live today is, we need to regulate the coders, or you probably heard the term on Twitter, like the super shadowy coders. That was a term coined by, was it Yellen? I'm not sure. Someone from I forgot who it was, but there was somebody in Congress or yeah, I forgot who it was. Yeah. So that was very interesting. So I think that regulators know, but they don't know who to put into who to hold accountable.
Yeah.
So the next one is, can Alameda manipulate Serum tokens legally?
Well, I mean, market manipulation is never legal.
Yeah.
Especially given how unlikely Serum was a commodity. There's probably rules around market manipulation for commodities too. I'm not an expert, but market manipulation is never legal.
I mean, you could argue that Serum was already manipulated by only providing 3% of its total supply to investors.
There's probably some very specific definitions for quote unquote market manipulation, but not a legal expert. So
next question is, what's happening with Serum? Are they forking, all the protocols that FTX launched? I've heard of one.
Yeah, I've heard of some rumors. I don't know what's happening there.
Serum is being forked because Serum is obviously central to a lot of the DeFi protocols. And so there are a group of people that I know are looking to fork Serum, or have forked Serum already, without the token, as a way to provide this as a greater utility for the Solana ecosystem. I did hear about that. Multi-coin catching a lot of smoke. Do you want to address that, Qiao?
I mean, there's nothing I know that the public doesn't know. I mean,
yeah,
I think their LP letter got leaked or something, and I mean, obviously they invested in FTX, and they had some on the order of 10% of their exposure on FTX as well. So,
yeah, look, I mean, the game, the whole venture capital industry is predicated on backing great founders. Obviously, there are going to be mistakes that happen, whether intentional or unintentional, and there is going to be reputational hit based on what those founders do, and to the extent that they do it. And I think it's one of those cases where Multicoin backed Solana, and then in return backed FTX and Serum, and one of those investments turned out to be really bad for them. So
we discussed this yesterday, just among us, and the question I asked was, would VCs have been able to catch this hole if they really did due diligence? And the answer was yes. And there were two red flags, really major red flags. One is the lack of independent board. on FTX. And two is their auditing firm, made up auditing firm, the first accounting firm in the metaverse. Can't remember the name of the auditing firm. But
I forgot what it's called, but they apparently were the first GAAP audited exchange, and it turned out to be some auditing firm that is primarily in the metaverse, quote unquote. And if you look on the Twitter handle, hopefully we'll share it after this call. But it was some like shady auditor in like some bespoke country. But that's like more on the growth side. On the early stage side, like when you're investing in a seed round, it's very hard to differentiate like a bad, like usually during a seed round, you're not like asking the founder to create a board, right? Or others. So this diligence should have been given to the later stage investors, like the Series A and B. And those are the ones, I mean, like ultimately it's the onus was on them to do that. And I'm actually very surprised because Sequoia, I mean, they've been around, I mean, they pretty much started the venture capital business. And they wrote this like an article that talked about effective altruism and why Sam is the next Elon Musk. And, I quite surprisingly, I'm surprised that they didn't catch this. And it tells you a lot about our venture industry generally, which is that a lot of it is just social signaling. And, it's just a bet on the founder of what they see on Twitter and, the product and et cetera. And I feel like that needs to change because it's primarily driven around that. It's never driven around like actual, like, let's sit down and figure out X, Y, and Z. Like a lot of the work that we do within the Alliance is making sure that there's product market fit, there's validation for the founders, they find their first 100, 200 customers. And so we see the users. But if you go on like out in just the industry generally, like primarily it's just like, okay, what are you pitching? Okay, we'll invest. Like, fine. But I think there needs to be more work around diligence and like working with the founders and understanding what they're building, who they are.
Everyone assumes everyone else has done the due diligence.
Yeah. Not the right. Yeah. I mean, I think that is one area that needs to change on the venture side. Qiao, okay. So Qiao got caught in the crosshairs with a private chat with deleted users. Give us details.
By the way, I left the group chat, so I don't even know the details anymore. But the context was Alameda's fundraising deck was being circulated among private Telegram groups, and I saw the deck myself. I had no intention to invest, but people who know me know that I always try to give a balanced view on things. And by the way, that was 2019. I didn't know Sam at all. I had just heard of Alameda and how they dominated the market. So I provided the stuff I heard of, which is Alameda was a very dominant market maker. And I also saw their P&L chart, which is basically in the pitch deck, which was a straight line up. That was extremely controversial. I also saw that they were raising at an interest rate of 15%. People were really shocked by that. I'm not sure why, but that 15% is very standard in the last 2 years, by the way. A lot of market makers have been borrowing at a rate similar to that. So these are the things that I mentioned. And at the same time, in the same group chat, I provided skepticism. I said that this high risk, no return quote that I put in the pitch deck is just pure amateur. But yeah, so that's basically what happened. I think, in hindsight, my alert level wasn't as high as it should have been. The high return, no risk. Like the next time you see I or anyone else sees that, just it's probably a scammer. Just don't dissociate from them.
But the thing is, like, this was so early on. We're just coming out of a bear market. And so, like we see like hundreds of pitch decks. And, we don't know which one is going to do what in the next 2 to 4 years, right? So this was just your 2-minute overview of what you skimmed and you gave feedback on it and you moved on, right?
Yeah.
Who would have known that, they went on to become this big exchange that crashed and hurt a lot of people? So I feel like it was just a very modest, like, feedback that you gave about Alameda.
Yeah.
Will crypto VCs continue to prefer tokens over equity?
Every market cycle in the past, in every bear market, VCs prefer equity over tokens.
Yeah.
And in the bull market, they start preferring tokens over equity. And founders know that. In the bull market, they raise for a token, and in the bear market, they raise for equity. So it's a cyclical thing. So in the next couple of years, probably we're going to see more equity deals.
Yeah, and the question also is, like, where does value accrue for the company in the long run, right? I think that is still a question, especially given where we are with regulations and what the token can actually do. Primarily, tokens are launched as a governance token, but how does value then accrue back to the token? You can't distribute profits back to the token holders. And so there are so many different regulatory regimes that tokens have to follow, especially given the fact that there is this classification of securities tokens or securities. And if you are deemed a security by providing profits to your shareholders or your token holders, then you are a security. So right now, governance tokens are meaningless. And the way they add some value is by giving you some rights into how things should be voted. But then again, there's a lot of like theatrical, ways where you can change the scale of the vote or the weight of the vote. And we could talk a bit about that later. But so that's kind of, And then the other is, like, we're starting to see a lot of startups add more businesses, right? So, like, and a great example of this is STEPN. And STEPN, first launched its program, which is like run to earn, etc. Turned out to be very, a lot of users, and they ended up launching an exchange under the Find Satoshi brand, and then now they're launching other product lines. So owning equity in the long run is going to be beneficial for for investors and the community members, because long term there could be a lot of great products that can come out of these great companies. What were people saying about Sam and FTX behind the scenes? Okay. So why don't we just talk about what we thought of him?
I mean, we already shared what we thought of them on 2 episodes ago on the podcast.
Well, we were very unbiased.
I tried to be unbiased. I always try to be. You were not unbiased. You I mean, we just called it out as it was. But I think the first red flag for me that happened around 3 months ago when Alameda when Sam went on Outlots with the Joe Weisenthal.
Yeah,
and he bashed crypto. He trash talked crypto, and he called crypto like Ponzi or pyramid or whatever, something like that. The whole episode was the first time I realized Sam was not a true believer in crypto. But even then, there was nothing that really suggested to me that he would have played with customers' money. 3 weeks ago, we learned that Sam was backing DCCPA, the bill that would have killed DeFi, secretly in DC. He was lobbying for that bill in DC. We wrote a thread originally the thread should have come from my personal account, but we decided it should go out of the Alliance official account. But we cut out the bullshit that was happening behind DCCPA. That was the time I realized that Sam was a bad actor in this space. He was a net negative to this space. But again, there was no evidence that Sam was playing with customers' money. So when the collapse happened last Tuesday, I was pretty shocked. The first day I was shocked. The second day I was angry. The third day I was laughing at this whole thing. Like, it was so absurd that I started just laughing at ourselves as an industry. But yeah, that's how my view has evolved around Sam. I know what some founders who were new to this industry thought of FTX and Sam. And we had I've spoken with founders who raised from FTX and or Alameda, and some of them had been in this space for a while, for many years. Others were new to this space, but they all thought that FTX played a pivotal role in the rise of Solana, which, by the way, was true. But they also, the tone that I heard was that they thought Alameda and FTX were good players. And in private, I expressed my skepticism to them, without knowing that FTX was even was committing fraud. I just expressed skepticism because I saw how Sam was not a true believer in this space, and he was backing DCCPA. So those are some of the things I've heard.
Yeah, I mean, I've heard very similar things. In fact, specifically with Alameda and founders, what I heard was Alameda is known to we're quick to dump tokens on founders, very quick. And it obviously, like, as much as we all hate to say it, but the health of the token, is important for the community, is important for the founder, and they keep an eye on it. And when you bring Alameda onto your round, and they get a significant amount of liquid tokens in return, that could be dumped on founders, right? And so I've heard stories of that directly from founders, where they will do that. Sam, just generally, from a long time, I'd say over the past year and a half, I'd never considered him as part of the core crypto group. His ideas and thoughts were, very institutional and against the crypto ethos. But that didn't make me feel like, I didn't feel like it was a red flag. Maybe it was good for adoption in the long run, bringing on great institutions, etc. But as the DCCPA came around, that's when his true color showed, which is that he will kill the ethos of crypto so that his institution can thrive. And if that's the case, then, that is someone that is very negative to the industry. And so our manifesto that was published on Twitter on October 13th was one of the biggest momentum shifts in regards to how serious people should be taking this. And in fact, brought on a lot more people to go against Sam, along with like Eric Warhes doing this debate on Bankless in regards to DCCPA. So
the first tweet, as far as I've seen, was against Sam was one confirmations tweet.
Richard Chen,
Richard. It was a short tweet, but obviously started the whole thing. The second tweet was ours. Yeah. And we detailed why DCCPA was bad for the industry, and that was probably the thing that kickstarted this whole change of opinion on public opinion on Sam.
But then what's also interesting is people are usually, not saying most, but a lot of people are afraid to talk or call people out on Twitter. And there is that notion of when is the right time to call someone out? I know there's a core group of Ethereum maxis that do this very often, to the point where it just becomes noise. But there are times where they're right. And so the question is, how should we be thinking about this?
I mean, when we were preparing for that thread on Twitter, we were debating whether or not we should do it. Just imagine how much like how much we would have lost if we were wrong, right?
Yeah.
Like the downside was not immediately clear to us that would outweigh the upside for us to call out someone like that before it was popular, before it was consensus against a really powerful player and all their allies.
Yep.
So but ultimately we made the call to do it. And in hindsight, I think we could have been more aggressive. And it was my failure to not have been more aggressive when I first saw the podcast on Alot. In fact, I subtweeted Sam several times without.
You did.
I don't know if you. Anyway, the tweets are still out there, but I said something like, we can't let someone who got so astronomically rich within the cycle represent our industry if that person does not believe in crypto.
So
go ahead.
So the Odd Lots conversation, if you listen to it, there's a part where he talked about a black box. Do you remember that?
Yeah.
He's like, well, you have this black box, which is like, let's assume it's a protocol that issues a token. Everybody knows that it's a protocol that issues a token. Nobody really knows what's inside of it and what it's doing. And so you could effectively launch this black box or this protocol that may have no value or utility, but you could issue a token against it. You can get a bunch of buyers that are willing to buy it and set a market price that they deem to be fair. And from that, you could, collateralize and borrow against those tokens. And he was pretty much explaining what he was doing.
Exactly.
And so which is insane. Like, he was talking about what he was doing. There was like 6 protocols that he launched where he was effectively doing that. All right, next question. Say you're running a DeFi project and Alameda was a significant holder of both equity invested and unvested tokens. Your cap table is in disarray. What do you do?
Yeah, so this touches a broader topic on Solana. Like, if you're a Solana project, what do you do? But let's address the first specific question.
Yeah.
I mean, is there anything you can do at this moment immediately?
If Alameda is a significant holder, there's not much you could do in regards to, there was an exchange, right? They gave you capital in return for future equity or tokens. And so the way you'd want to think about this is like, you have to allow the liquidators do their job.
Yep.
In regards to where the token's going to go and how it's going to sit and how it's going to get distributed. This could take 10 years, by the way. Like, if you look at like Mt. Gox, it took them over a decade and people still haven't received their tokens.
My Gox coin they still haven't been given back to me. And it's been like 8 years. Yeah.
So I guess, there's some assurance that at least your tokens won't be sold against you for a very long time. And so that's like 1, right? 2 is, if you want to change the cap table or like bring on more healthier investors, and if you're depending on where you are in the project cycle, it might be good for you to raise some capital and increase your runway and bring on more diversity of investors on your cap table. And that is pretty much predicated on where you are in terms of success, etc. I guess those are like 2 immediate like feedback points I can give.
And as for Solana in general, I think right now the consensus view is that Solana equals FTX. FTX goes down, Solana is fucked. I hold the opposite view. I think that view is wrong. That consensus view is wrong. I think if this whole FTX thing happened a year ago, yes, I would have agreed that Solana is probably, set back for many years. Because FTX back then was a dominant player in Solana. Like, it's true that FTX was responsible for the early growth of Solana, but it's been a year now. It's been more than a year, and I think relatively speaking, FTX and Alameda are less dominant of a player. It's no longer an indispensable player in the Solana ecosystem, because Solana actually, attracted a bunch of really high quality developers. And why can I say that with confidence is because I review 1,000 applications to Alliance per quarter, and the stats shows that 20% of our applications are super high quality Solana developers. And so Solana has definitely reached this critical mass of developers, quality developers. And so I would actively bet against that consensus view that Solana is not gonna die with FTX. Now, obviously, there's still a risk because right now I think that all the Solana developers are in a sort of prisoner's dilemma kind of mental state, meaning they're looking up to each other, right? If their peers are gonna leave Solana to join, like, let's say Aptos or Sway, they're probably gonna do that too. But if their peers stay in Solana, they're probably gonna stay as well, right? So it's a prisoner's dilemma. So I think ultimately it boils down to the leadership of Solana and the devs that Solana devs look up to. So they need to take leadership to rally everyone around, and I think they're doing that. So we'll see how it plays out.
Yeah, my two cents on that is, I think this is the rallying moment for Solana. What we're seeing is Solana, like if you look at all the layer ones today, a lot of the organic growth outside of Ethereum and the layer twos, Solana is like number 2 to Ethereum and all the layer twos. So I'm putting that aside. And so what they should focus on, which I'm hearing they are, is, going on, visiting founders, getting them back to focus on building in the space, making sure that they confirm that Solana is here to stay and it's going to be successful in the long run. The other thing is, I'm kind of like, I hate to say this, but it's better that it happened now than later. And the reason for that is, if Solana gets bigger and FTX starts to continue being a large part of the Solana's ecosystem, who knows what the ecosystem could look like in the future, right? Given how much of a central point Serum plays into a lot of these DeFi protocols. So even though like I find this to be very bad and horrific, getting Serum and the Sam out of the Solana DeFi, Solana ecosystem is probably going to make it much more stronger in the long run.
That's what I said to our Solana founders as well. It's like LLC, like the alternative that FTX does not die is probably a worse universe, parallel universe than the one that we live in.
What's the next question? What surprises me is Paradigm. I mean, Fred built Coinbase.
Surprising in what sense? That they backed FTX?
Yeah.
I mean, it feels like it was Matt that led the investment. I mean, it's my speculation, but Matt is the one who tweeted about FTX. But I feel like in general for those mega funds, like they tend to have like someone internally who would vouch for a potential investment and try to push internally within the investment committee. So there's usually one person within the investment committee to lead the investment, and so they probably vote or something. I don't know how the system works at Paradigm, but it feels like Fred was not directly involved, but that's my speculation.
Yeah, similar to yours. Next question. Would love your take on the healthiest approach to centralized exchange regulation. Let's all assume we all love DeFi, but centralized exchanges are a necessary bridge for now. Should be still be used less than more. So I guess an example of this. Yeah, go ahead.
I actually have a prediction for this for the coming years. So again, like at the beginning of this session, I mentioned that the biggest elephant in the room is the fact that with FTX or even centralized exchanges in general in crypto, you have the front end, the user front end, retail user front end, the matching engine, the clearing, the settlement, and the market maker in the case of Alameda. All these things are lumped together into one giant entity. And I was actually debating with Kyle, like it's still on Twitter. I was debating with Kyle a few months ago. Like Kyle was saying, this is a huge innovation. I said this gave huge perverse incentives to those giant entities to do potentially bad things to their customers. And FTX did. So my prediction for the next few years is there's going to be more push from users, like actual demand from users, and definitely the community to decouple all these different layers of the stack, from the front end to the settlement to the matching engine to the clearing to the market maker. I think that has to happen. If that happens, then we're going to have a solution where you as a user, you store your money, let's say in some custodian, but you trade your assets on a centralized exchange. And these two will be totally separate. If you look at how TradFi works, TradFi is decoupled, right? Like when you open a let's say a Fidelity account, and Fidelity is your user front end, but Fidelity, I don't believe they hold your money. Your money is probably held at a bank or something, or a prime broker, and the trade is done. The matching engine at the matching engine level at Nasdaq or NYSE. And if you trade derivatives, there's a separate clearinghouse that would clear your derivative trades, right? All these things are decoupled in TradFi. I think we're going to see something similar in crypto with the centralized exchanges. And I hope that the leaders at those centralized exchanges will push towards that vision as well. Obviously, it's going to be a humongous task when it comes to the tech, the organization, the logistics, the legal. It's a big challenge, but I think we're going to see that. And if we do see that, we're going to have a solution, a CeFi solution that's, again, it's still worse than DeFi in my opinion. I just want centralization, but it will be close to what we have in DeFi in terms of security for users.
And two additional points to Nolan's question is proof of reserves. What are our thoughts on that? More or less regs for centralized exchanges. I think, like personally, they're all like good snapshots, but everything could be faked, right?
Okay.
As you've seen with Gate.io and Crypto.com, they were sending each other funds back and forth so that they can create the snapshot of their proof of reserves. And so, you know, exchanges, especially that are offshore outside of the US, it's very hard to hold them accountable for anything, really. And it's up to them on what they can do based on a jurisdiction they're out of.
And the other like really obvious way to fake the proof of reserve is, let's say the exchange has $10 billion worth of customer deposits, but no one knows. And then they show a proof of reserve for $5 billion and claim that they have $5 billion worth of customer deposit. How would you ever know that there is a $5 billion hole, right?
You can't.
You can only prove, like you're proving A equals B, right? But the proof of reserve only shows A. You can never prove B, right?
I mean, this is like back to 2008, like rehypothecation of assets, right? Like people just borrow against assets that just, it's like recursive. And the whole ship can just blow up just based on people acknowledging that there's money in someone's balance sheet, but we don't know.
By the way, I'm not saying proof of reserve is useless. It's probably has some utility, but it's not sufficient. That's what I'm trying to say.
Yeah. You know, I'm actually very bullish on Coinbase's MPC tech as well.
Mm-hmm.
The MPC wallet, obviously is the ability for Coinbase and the user to custody their own assets where they own it, right? And it gives Coinbase some sort of like security clearance over your assets so that you're able to go out and do whatever you want, whether it's to protect your assets, whether it's to use the assets on Aave or Uniswap or whatever. But I'm pretty bullish on Coinbase's MPC tech.
The MPC tech is actually in line with what I mentioned earlier about decoupling, right? Like when you use the Coinbase MPC wallet, you're basically using Coinbase as the front end, but you still have you're basically doing self custody, in a semi custodial way alongside Coinbase, but it's far more decoupled than things currently are.
So what's interesting that, over the past like hour we were talking about just Sam, FTX, centralization, it turns out a lot of our solutions to these problems are protocols and crypto just generally, right? Like the wallet, the MPC tech what we're talking about is a multi-party computation, which is essentially a bunch of keys that represents the private key. You hold, one of three, maybe two of three is held by Coinbase, and you need their acknowledgement to validate your key so that you can host a transaction or post a transaction. And it turns out like Aave, Uniswap, and all of the infrastructure that's behind it, it's more important than today that, technologies like this need to be in place versus, giving our trust to a group of people that will manage the capital on behalf of us. Given the fall of Voyager, Celsius, Theros, and etc., I think it's more important than now than that we use DeFi and wallet infrastructure.
Yeah, and in fact, if you look at the data from this past week, I think there was a lot of data suggesting that DeFi usage has gone up across spot exchanges as well as decentralized exchanges. In fact, last week in the top 100 assets on CoinGecko, the only two, maybe a handful, but two of the assets that were up that stood out to me was GMX and DYDX.
Yep.
Everything else was down like 20 to 50%.
So the future's there if you're looking for validation for DeFi. All right. Thoughts on 12-week digital dollar experiment launch? Yeah, I saw this announcement. I think this was yesterday or today.
What is that?
So the New York Federal Reserve and partnered with a bunch of global banks to launch a 12-week digital dollar pilot. Okay. Interesting timing. And in fact, this was, today. This was 2 hours ago. And so, CBDC, right? Central bank digital currencies. Timing wise is very interesting because it was right at the end of the collapse of FTX.
If you look at everything that happened over the last week, it's very hard not to get conspiratorial.
Very hard.
The NYT article that spoke positively about Sam and previous one negatively about Coinbase. It's absurd.
I mean, Sam's. I don't want to put my tinfoil hat on here, so I'll pass on this. What are your thoughts about the Solana DeFi state now?
I mean, Solana just lost a major market maker and a major venture investor. So in the short term, Solana is getting hit. But as I've said many times in the past, the only leading indicator that you should care about when it comes to future growth of an ecosystem, layer one ecosystem, is the number of high quality developers. That's the only thing I'm tracking.
Yeah, same. I mean, like if you look at, Solend, I think Solend's at like $30 million TVL now. I mean, at one point they were at like a couple $100 million.
No.
I think $1 billion at one point during the bull market. Obviously it's inflated, but Solend and many of the core protocols to DeFi they're still building. In fact, many of the startups are as Qiao mentioned, that have applied. Many of them are coming from the Solana DeFi ecosystem, and we're talking like incredible founders in the space. And so the growth of talent isn't going to stop. What happened with the liquidity crisis within Solana's DeFi ecosystem? Yes, there is enough liquidity, obviously, in the space to, get to help scale the DeFi products. But I think that's probably true for many areas of DeFi today, except for like Uniswap, Aave, and Compound, and Synthetics. And so I think over time that will be resolved. But for now, I think it's just really putting your heads down and like building and coming up with some great products that could solve the catastrophes that we went through over the past couple of weeks. With FTX gone, there's a void for non-KYC perps. In your opinion, who is the front runner in that category?
I mean, right now by the numbers, it's GMX. And yeah, DYDX is doing KYC, right? So DYDX is out of the question. I mean, by the numbers, is GMX.
Wait, why is DYDX out of the game?
Don't they do KYC? Because the question was...
What they do is... they don't allow you, like it's a VPN or it's a IP block, right? So if your IP is originated from US, you can't trade on the platform. And they will do like random ID verification check, which I think they stopped from what I remember, because people found that to be annoying. And so I think they stopped it. But I think DYDX, you can still trade technically outside of the US.
Okay. I haven't used DYDX in a very long time. The last time I looked at DYDX as a user was like a year ago. And back then there was no, I can't remember when that was, but there was no KYC. I remember at some point they started doing some KYC stuff, but I didn't follow the details. But like, even if you include DYDX, I think, if you look at the numbers, I think GMX is number one. So like the top DeFi protocols right now are by 7-day fees are Uniswap, Lido, if you consider as DeFi, PancakeSwap, GMX.
PancakeSwap?
Yeah.
Wow, Binance Change is still alive and thriving.
That's right.
Very surprising. DYDX I think is, and others are front running right now on that side. Yep. What does FTX BlockFi collapse mean for crypto? So many regular people won't trust crypto anymore.
Yeah, I mean, that's right. What's going to happen in the next 2 years is obviously average users are not going to trust crypto. Regulators, policymakers are not going to trust crypto. They're going to try to deploy aggressive regulations. I'm not even speculating. Like, this is something that happens over and over again in history. Every time shit like that happens, you get more aggressive regulations. It's just history. It's not even my speculation. Developers, builders that, last year there were a lot of Web2 builders that joined Web3, and we're not going to see that. We're going to see much less of that in the coming years. So the combination of these three things means that the industry is probably has been set back for at least a year or two. But the silver lining is that in 2014, I said to myself, after Mt. Gox, I said to myself, there's no light at the end of the tunnel. Like, this is a nuclear winter. There's no way crypto is going to come back for like the next 5 years. And yet crypto came back in 2017. And what led that? Well, obviously the 2017 bull market was not pretty. It was led by ICOs, but ICOs were fundamentally enabled by Ethereum. Ethereum was fundamentally an innovation when it comes to programmability. Layer 1 programmability. So in my opinion, the 2017 bull market was actually led by tech innovation. The 2020, 2021 bull market, in my opinion, was led by the Fed, mostly.
Sir Jerome.
Sir Jerome. So point being, yes, it looks like, you might feel like there's no light at the end of the tunnel, but if we can build real products, real innovation in this bear market, the bull market is going to come back sooner than you expect.
I mean, like, look, crypto is very volatile, right? So you're going to have euphoric moments and you're going to have moments where things are going to completely die out. That's just what an emerging technology is going to feel like, right? The difference with this sector versus any other sector that has ever come out is that there's a financial asset that is directly tied to the industry, and everyone's net worth is a part of that industry as well. So this becomes a very emotional game.
That's right.
Or industry for everyone that's building in the space, including people that are like looking into build. And so it's very different than your average industry. Like if you look at artificial intelligence or machine learning, there isn't your net worth isn't tied to those industries except for the startups that you build, right? Yeah. In this case, everything is a part, like everything that you do is a part of this industry, including your net worth. So it is a very polarized effect compared to any other industry. But I mean, that's why I'm here for it, right?
The market, the price in the token is a magnifier of everything. In the bull market, the price attracts, growing price attracts more people. In the bear market, the falling token price makes people more skeptical about this field.
All right. How bad is the contagion? How many companies, VCs are hit? What we'll see coming out?
Contagion is obviously not over. There's going to be more dominoes to fall. Yeah. But I mean, again, like the liquid funds are probably hit. The VCs probably less so, unless they also run a liquid fund, which a lot of them do. I don't know. Like that's the only thing that came to mind. Do you have anything? Any insights?
Yeah, I mentioned this a bit earlier, which is like 7% of all of crypto funds AUM in the industry has been affected. So between 1 to 5 billion, I'd say probably 2 to 3 billion from the investor side. On the startup side, on average, I've seen about 50% runway cut for those investors or for those startups that have put some assets on FTX. I haven't seen startups shut down yet. Maybe I've seen one on Twitter that talked about it publicly. So obviously like runway is cut short. And so they need to either come with, get to product market fit quickly, or they need to turn it off and return the money back to their investors, which is probably the diligent thing to do, or raise more capital depending on where they are in their product life cycle.
Part of the question was, how much worse can this get? Well, I said earlier, there will be more dominoes to fall, but I think it's very hard for things to get meaningfully worse than they already are today. Meaning, FTX was so dominant, so big that after the fall of FTX, it's very hard for someone else, like for someone else to create a much worse impact. That entity to fall, that domino to fall, needs to be even bigger than FTX. If they're smaller, then the impact is marginal, is incremental. And I think there are only, the other day I was thinking about this, and there are only two things that I can think of that if they fall, it's going to be much worse than it's going to make things much worse than things currently are. And those two things are, number one, the collapse of a major stablecoin. And by the way, I don't see any evidence of that. And the second thing is the collapse of a major crypto bank, a bank that banks crypto startups. Mm-hmm. If the bank runs into a bank run, then it's nuclear winter. All the startups are fucked. By the way, there's no evidence. I haven't seen any evidence of that either. Just to be clear.
Well, there's another one, which is probably the last or the final boss. You remember that meme where you have the Grim Reaper that knocks on each door, and then there's like a X mark. The final MicroStrategy, or Sir Michael Saylor. Some people consider him not human, and so he can't be on that list. I tend to agree with that. So Yeah, I mean, that could happen. I mean, everything's on the table. I wasn't gonna. I didn't see FTX on my list here. So I think his position, like I think he could be liquidated at 13.5 was what I saw last Bitcoin, where he has to post up like $400 million more in collateral.
Okay.
But yeah, I saw that.
How much Bitcoin do they own?
2 billion? Probably more.
Billion.
Yeah. I think more. I'm not sure.
Again, like even if it's $2 billion, I mean, it's gonna have some market impact for sure. But 2 billion for $500 billion asset class, it's not too bad. But
he owns. Okay. It's at 3.4 billion. So,
okay. But more importantly, if MicroStrategy gets liquidated, it's just liquidation. It's not a reputational damage like as much as FTX has done to our industry. The main problem is the fraud, is the reputational damage.
Cool. I think those are it for our questions. So want to thank our audience for tuning in and listening and asking some great questions. Do we want to share maybe some lessons learned before we tune out?
Yeah. You want to go first or?
Yeah, I mean, look, for me, it has been that, well, this is just me observing. What I've observed over the past 2 years is the fear of missing out, or the FOMO piece, right? And this has become probably the single largest problem that I see in our industry, which is, this whole ape first culture, right? If you remember that. That there's opportunity cost if you don't ape first, and that has kind of like propagated to everyone in the industry, right? If you look at why Three Arrows went down, or why Sam went down, or Terra, Luna, whoever, it's this idea that like you need to go in and you need to go heavy and lever up because that there's a missing of an opportunity, and you're starting to see you saw this with investors too. If you remember, over the past 2 years, like if we didn't commit within 24 hours of an opportunity for a startup, that they would just move on to another investor that would commit first, right? And so that put a lot of pressure on us to commit, but thankfully we focused on our diligence for the most part. I mean, there were times where we also committed, but there is this kind of industry-wide like push to FOMO in on opportunities and go all in. So I feel like that's one area that I think that we all could improve on as an industry.
The funny thing about both SBF and Three Arrows was that they both talked about linear wealth. I don't even remember.
Yes.
Back in the day. Basically, well, just in short, linear wealth means like, well, the implication is if you see an opportunity and if you think the expected value is positive, you're going to go all in.
Yeah.
You don't care about risks of total ruin. They both, bragged about being a linear wealth seeker and looked down on the log wealth seekers. Well, it's fine if you're a linear wealth seeker. It's I don't care. But if you're gonna pursue a linear wealth, don't borrow money from others. Don't play with the wealth of others.
No leverage.
Don't leverage. The lesson being, next time you see linear wealth seekers, don't lend them money. It's destructive. And don't leverage recklessly. The famous Charlie Munger quote: "There are 3 ways our smart man can go broke: liquor, ladies, leverage." The 3 L's. And that was leverage was the thing that everyone from Terra to 3 Arrows to Celsius to Alameda committed. So that's one lesson. I think that another lesson is, again, like the separation of market makers, clearing, settlement, matching engine, user front end. We need to get that done in the coming years.
Mm-hmm.
Another one would be just be more aggressive in calling out bad actors. And I mean, I failed at that. I should have done it much earlier, much more aggressive. But we can't let bad actors. We can't give them a second chance. What else?
For
self-custody.
Go ahead. Yeah.
Self-custody. I mean, it's fine to use centralized exchanges for trading, but for custody, do self-custody. Mm-hmm. Or if you're an institution, use a reputable institutional custodian. And one thing I really want, I came across this problem myself yesterday. This pain point was, why is there not a decentralized stablecoin that I can trust and park my crypto there? Because the alternatives right now are, putting your money on a centralized exchange, or putting your money in a centralized stablecoin, which, by the way, also has counterparty risks. Even if you do self-custody, there's counterparty risks because you don't like the US dollar that's backing the stablecoin, that has counterparty risks. So I would love for us to have a really good decentralized stablecoins in the coming years.
For me, some of the areas, and I think a lot of part of the FOMO culture that crypto built was also propagated by media, which is, they largely don't know what they're talking about, and you don't know what happens behind closed doors. And so the narratives that are built, like for me, the biggest narrative that I questioned was like his SBF's like rise to fame, right? Why is it that like the media, created this monster as an example, right? In a way that ultimately hurt our industry. What are the diligence that they do? What are the messages that they're putting out there? Why are they doing this? And so what you see in the media, always be skeptical. And don't use that as a way to validate or invalidate your thesis. Like, think about it and start to do reference checks, and don't let the media decide what you want to, like, how are you going to make your, how are you going to move forward? So media is like a large part. Don't believe it. Be skeptical, and then do proper diligence. I'd say the other is, a lot of founders were hurt by the FTX situation, where they put their assets on FTX. So I always tell our founders that you should have a redundancy plan, right? So even though Coinbase is the most valuable and secure exchange today in the world, make sure you have a redundancy plan where you have some on Fireblocks, you have some on Coinbase, and in your traditional banking account, because ultimately you'll never know what's going to happen. And so always have a backup plan. And then the last thing I just thought of was just going back to my first point, which is like, you'll see a lot of narratives. Like the biggest narrative that I saw was Brian against FTX, hence why we did our podcast around Brian and Sam. And you'll see a bunch of people that will validate a thesis that may not be true. And so again, when you see these narratives play out, make sure that you do your own proper diligence, and you don't like ape in or automatically trust the assumptions of people that are providing that assumption for you. I see this happening all the time. And so in introspect, just like think about it and make sure you make the calls the way you think they play out. So those are just like some final tidbits on that.
Cool.
All right. Well, thank you for tuning in, and we'll catch you again on episode 7 in 2 weeks. Thanks so much.
See you later.
Thanks for listening to Good Game. Don't forget to subscribe. We'll see you next week.